everyone. Hope everyone had a great Thanksgiving holiday. I'm recording this here heading into the last trading week of November 2023. It has certainly been an eventful year this year in terms of global macroeconomic uncertainty. We've had the rise of AI, which distorted parts of the market and caused long duration equities, tech stocks basically to bid up again and lead this market higher. I'll have a couple of charts on that and a couple of discussion points. What I would like to ponder here today as we round out November and head into December 23, we have about 3 weeks left of trading, real trading, if that, but I do think the coming weeks are still going to be important, is really whether stocks are right or the bond market is right. So the way we can look at this is through the lens of economic cyclicality. And I'm going to discuss a couple of charts here, a couple of points. I will quickly also show this screen here for those people watching this on YouTube. Again, and I always say, if you're not watching this on YouTube, do not worry. I will describe these charts just as well as one would be able to see them. But again, it really all comes down to interest rates. And it comes down to interest rates where we were 2 years ago and where we are right now. We have got to come to the grips that the rate of change in interest rates is more important than the absolute level of interest rates, although that latter part too is important. And so what we're starting to see is the delinquency rates, for example, in credit cards, which I know some people are talking about, where we're seeing them at like shocking rates. We are seeing delinquency rates of particularly the lower credit rating consumer credit card types. That's your Discovery Financial and your Capital One, for example. And what we tend to see there is a serious rise in those delinquency rates versus, let's say, Visa and MasterCard. We're seeing an absolute spike in unsold vehicles as well. Inventory levels are rising. The bull case here is that the bulls will argue that's great that the supply chain is working again. In the bear case as well, they're all sitting on the lot and not being sold. What does that mean? Maybe somewhere in between is where we come down to typically in most of these things, meaning it basically means maybe we're going back to a better inventory level than the completely depleted inventory level. I remember getting just after I'm going to say it was 2022, might have been 2021 actually. In 2021, getting in the mail from the dealership that I bought one of my cars at, an offer to purchase the car from me at a price that was actually a few $1,000s more than I had purchased the car about 4 years prior. The used car sale numbers levels are still high. I was actually recently checking. I still have that car on what the level would be, the price level that would be acceptable in the market, and it was still quite high. It hasn't really come down a lot, but either way, we're seeing a slowdown. Now, where this comes, a really important question for people's portfolios is, what does that mean in terms of the market? Does that mean that the interest rate levels from here are not going to matter for the economy? There's almost a 0% chance of that. But does it mean that we have to have an economic crash? I don't think so. That's necessarily the case either. What we need to keep in mind, though, is that even a soft landing doesn't mean there will be a landing, right? So whether we crash or we soft land, ultimately the plane lands, the economy lands and slows down. We've had this soft landing for the past year and a half or so, and indeed it's been a soft landing so far, depending on where you look, although some people would disagree based on their sort of demographical situation they live in. But sort of in the aggregate, it's been a fairly soft landing, but ultimately, again, the economy will land. So we will ultimately have very little to no to potentially negative growth. So let's keep that in mind. So everything that's taken place over the past year and a half is basically just part of what has to happen. You have to land before you have to proceed to land before you actually land the economy or the plane. The question I want to ponder here specifically is whether the stock market is right about this soft landing or the bond market is right. So let me walk you through a couple of specific scenarios. So what I'm going to do here is I'm going to juxtapose the equity market to the bond market, and we are going to be looking at that through the lens of divergences. As we talked about, I think last week too, is what's notable here is that the equity market rally that we've seen since late October, early November, very much coincided with a peaking in interest rates. In fact, 10-year yields peaked in the middle October around 5%, then made a series of marginal lower highs until the equity market picked up on that literally at the end of October heading into November, and then bond yields really crashed and the equity market moved higher. So the question now is, which market is right? Is the equity market right? Or is the bond market right? I'll walk you through two potential scenarios and then a solution in terms of how I think portfolios could now be constructed. Remember, this is not financial advice. This is really just my view and my research. If the equity market is right, they're not as bad as people think, might actually be rosy, which does also kind of nod to potentially that interest rates don't matter. So keep that in mind, which is, of course, absurd. But if the equity market is right, long duration assets are the way we're going to go, and the Russell 2000 is going to start catching up to the broader market higher. And I think that's too early, but it will happen at some point. Maybe we have to have a recession first, though, which is maybe where I'm leaning to. But if the equity market is right, let me get to it finally, then that means that the bond market is likely going to sell off again, meaning bond prices lower, bond yields up. Because if the equity market is strong, basically has a nodding to positive, to higher growth, then there's very little reason for the bond market, bond yields to come down significantly. That means bond yields likely go higher again, or at least stay where they are, at the very least, and the bond market at the margin will probably go lower. So that's the equity market scenario, but it also most likely means equities are probably capped as well. They have very limited upside. Why? Because of what I just said. Interest rates will probably going to maybe go back up again, or at least remain where they are, in which case the equity market, too, with a higher discount rate, right? Basic DCF models, discounted cash flow model, you apply a higher discount rate to the future value of earnings, get you a lower net present value of future earnings, meaning a lower stock price. If stocks are right, stocks upside is likely limited. What about if the bond market? If the bond market is right and yields have now come down because they're concerned about not only the economy, first of all, they've celebrated now the stopping of hiking of interest rates. Fed is most likely done hiking rates for now. So that's why the bond yields came down, bond prices rallied. So the bond market is right, and ultimately bond prices would continue to rise in that scenario. Hypothetically speaking, bond yields come down. That has to take into consideration a somewhat slowing or softening of the economy. If that's the case, the equity market is going to come down. And bonds, however, are probably limited in terms of how much they can rise. Why? Because we're heading into an election year. If the economy slows hard enough, the stock market comes down, what is the natural reaction function going to be of politicians? And again, remember, the Fed will be, at least in my humble opinion, will be somehow politically inspired to do what they want to happen in Washington. They're likely going to start being more stimulative again. And that could be both on the monetary side and, of course, as it is already taking place on the fiscal side. Those are the two scenarios. But again, either scenario, upside is limited, whether it's stocks being upside limited in the upside if stocks are right, or the bond market being limited in terms of the upside if the stock market's right. So in either case, both these asset classes are either limited in the upside, short. For me, from a directional perspective, I wouldn't mind being certainly net short equities. Does not mean I lever up to the moon, but net short equities, and probably not also very long the bond market. Now, the bond market, one could be short directionally from a trading perspective, but long cash, right? So we still want to reap the rewards of these high relatively high, or maybe just average long-term interest rates we have. So we want to, still be able to play with a lot of cash on the side, being invested in the bond market, and then maybe being short equities and potentially even somewhat short the bond. In either scenario, what I see is very limited upside in the bond market, and I see very little upside in the equity market. And I quickly need to stop sharing the screen here. But that is what I see as most likely, because we are in a range bound type of market. And I think that's what a lot of people are still, for some reason, willing to wake up to, or just can't get their head around to. I don't really know why the reason. But let's take a step aside and look further, because a lot of people are talking about this rally having to expand now, and the small cap stocks have to start catching up. I'm going to quickly describe this here, but small cap stocks, looking at the Russell 2000, have acted really badly this year. They've bounced sharply right now over the past few weeks, and they're basically flat for the year. And I will quickly talk about this, and I'm going to construct a chart here at the same time so people can see this. But the Russell 2000, particularly compared to the S&P 500, is really acting badly. And it's because it's reflecting more of what the reality in the economy. So the Russell 2000 is up 4% for the year, which actually is still pretty good. The S&P is up 20. Where the rubber meets the road is the ratio of TY divided by IWM, so S&P 500 divided by Russell 2000, has been making actually an absolute relative high in November, which honestly could go either way, which for now seems like that's potentially a bullish sign. So people are talking about the Russell 2000 having to catch up and breaking higher. I think what we might see is a flattening of that ratio. So the Russell 2000 not really doing a lot better than the S&P, but the S&P at the same time probably going to start acting less well as well, because we have had this severe rally in tech stocks. Again, speaking of tech stocks, very short-term comment here. Shares of Intel, they've been a major underperformer over many years now, and have just had a dramatic rally. I think they're short-term overbought. Semiconductor stocks, probably in general as well. NVIDIA earnings are out of the way. Last week we had them report earnings. We'll see, but I see limited upside here as well. So you can see the overarching message is limited upside from here, where it's equities, whether it's equities or bonds. So you take that for what it's worth, but from a portfolio construction perspective, take that and talk to your investment advisor about it. Otherwise, come to us at Blue Marlin Advisors, and we're happy to talk to you about what that means from a portfolio construction perspective, from a trading perspective as well. These are important considerations about a portfolio going forward if we do have limited upside in equities. Again, people haven't really cared yet about their long-term portfolio, because guess what? The S&P is back to where it was 2 years ago. They don't really care that they haven't made money, apparently. They will at some point, but I guess it just takes more time and more pain probably for people to wake up to this. And what I'm hoping, and the reason I started the Steady Wealth podcast, is to be able to prepare people proactively and not have drawdowns of 50% in their long-term nest eggs, or blow up their trading accounts because they're not aware of the bigger pictures, the bigger tailwinds, or the bigger picture headwinds. So again, hope this two-part scenario analysis is helpful. Again, as always, this is not investment advice. It's just our research. And if you have any questions, please let us know. You can email support@thesteadytrader.com. If you have any questions or inquiries over at Blue Marlin Advisor for the investment advisory firm, you can go to www.bluemarlinadvisor.com, and we'll be happy to look at your portfolio. In the meantime, have a great rest of your November, and we'll see you back here in December.